Every month, on the same day, you send a payment out into the world. It leaves your account and disappears into someone else's. You call it rent. But the real answer is far stranger. That payment isn't temporary at all. It's doing something permanent every single month, just not for you. Somewhere across town, a person you've probably never met is getting a little richer because of you. Not through some scheme, just through math you were never taught to notice. Your brain doesn't naturally think in decades. It thinks in months, in bills, in whatever keeps the lights on right now. Your ancestors didn't survive by planning for retirement. They survived by solving today's problem today. So when a landlord offers you shelter for a fixed number, your brain accepts it easily. No long-term math, just relief. But when you pay rent, you're paying for two things at once, and only one of them helps you. The first is shelter. The second is something economists call equity, and it's quietly transferring from your pocket into someone else's. Think of a house as a jar. Every month, someone drops a coin into it. If you own the house, the coin lands in your jar. If you rent, it lands in your landlord's jar, and you never even see it happen. The Yale economist Robert Shiller spent decades studying home prices, building the index that still bears his name today. His research found something counterintuitive. Owning a home isn't really about picking the right investment. It's about being forced to save, whether you feel like it or not. Renters almost never save the difference on their own. Homeowners don't get a choice. The mortgage does the saving for them. Why does this matter over a lifetime? Because of amortization. Early on, most of your payment goes toward interest, almost like rent to the bank. But slowly, the balance tips. More of each payment chips away at the loan itself. Eventually, you're not paying the bank anymore. You're paying yourself. A renter's payment never tips. Year 1 and year 20 look identical. The coin always lands in someone else's jar. Here's where it gets stranger. The economist Thomas Piketty studied something even bigger than housing, the growth of wealth itself. His research showed that returns on owning assets tend to outpace returns on wages from working. A house is one of the only major assets an average person can actually own outright. It becomes their one real foothold inside a system where owning almost always beats working. So who ends up owning the homes that renters live in? Often people who already own property elsewhere. Researchers at the Federal Reserve, including economist William Emmons, have studied how homeownership shapes the wealth gap between households. Their findings are stark. Owners build wealth over decades. Renters, even earning identical incomes, often build almost none. The gap isn't explained by income, it's explained by ownership. Two people can earn the same salary for 20 years. One rents, one owns. By the end, their financial lives can look nothing alike. Not because one worked harder, because one was building an asset with every payment, and the other was building someone else's. Why don't more people see this? Because the math is slow, and slow things are invisible. There's no notification that says, "Congratulations, you just bought one more brick of your future." It happens silently, over years. Renting feels safe because it's simple. No repairs, no property tax, no surprises. That simplicity is real, but it has a cost. Every dollar you send out the door disappears completely. It buys you a month. It buys your landlord a future. For almost all of human history, land wasn't something an ordinary person could realistically acquire. It belonged to kings, to nobles, to whoever held power. The idea that a regular working person could sign a piece of paper and slowly become the outright owner of land is remarkably new. It's only existed at scale for less than a century. Programs built to make ownership possible for ordinary people, low down payments, government-backed loans, extended terms, exist precisely because someone noticed this imbalance. They let regular income quietly do what only inherited wealth used to do. But none of that helps you if you're the one paying someone else's mortgage instead of your own. Ask yourself something uncomfortable. If your rent and a mortgage payment were roughly the same size, who is that money actually working for right now? For most renters, the honest answer is not you. It's working for your landlord's equity. your landlord's eventual sale price. You're quietly funding someone else's early retirement. This isn't a moral failing, it's a structural blind spot, one your brain isn't wired to notice because it evolved to solve short-term survival, not 30-year arithmetic. Shelter now feels more urgent than equity later. That instinct kept your ancestors alive. It just wasn't built for mortgages. So what changes once you see the mechanism? You stop asking whether you can afford the payment and start asking a better question. Whose jar is this coin landing in? Because every month, that question has already been answered, whether you noticed it or not. The payment leaves your account either way. The only thing that changes is who ends up richer 20 years from now. And that's the real answer. It was never really about rent versus a mortgage. It was about which jar your money has been quietly filling this entire time, and whether you're finally ready to make sure it's your own.